Good morning and welcome to the Success Exchange powered by Goba Capital, a space where ideas, strategies, and stories intersect to inspire growth in finance, business, and innovation. This podcast brings together business leaders and industry experts to share insights and perspective on various current events. Each episode explores real-world strategies, best practice, and personal success stories that empower listeners to navigate challenges, seize new opportunities, and accelerate their journey in the ever-evolving landscape of business. I'm your host, Cole Thompson, and today's topic is cross-border trade, with a particular focus on commodities, unmasking fraud, and de-risking operational and supply chain risk. Commodities markets are essential to the global economy. It is a $1 trillion industry that makes up 2 to 3% of the world GDP and drives industries ranging from food processing to manufacturing. However, as the industry expands, so do the risks, the primary one being fraud. High-profile fraud cases have led many traditional banks and conventional lenders to exit the space, leaving a credit vacuum now being filled by alternative finance and private capital providers. Recent studies show fraud losses in commodities finance have surged. The Commodity Futures Trading Commission recently announced record of over $17 billion in damages for fiscal year 2024, with Asia, Africa, and Latin America being particularly impacted. Today, we're joined by three experts to discuss the risks and opportunities in this space. Anton Posner from Mercury Resources is a supply chain and logistics expert focused on transportation services, collateral, and risk management. John Basquill from Global Trade Review is a UK-based senior reporter. And Peter Ryan from Goba Capital is an expert in alternative finance and commodities. Gentlemen, welcome. I'd like to now turn it over to you so that we can share more and learn more about your backgrounds, and so that we can dive into today's discussions and questions. Let's start with Anton and work our way over to Peter.
Okay. Good morning, Cole and team. Great to be here. Great to be part of the inaugural Goba Capital podcast. So, as you said, Cole, I'm the Chief Executive Officer of Mercury Resources and the Mercury Group. We're a global supply chain management company focusing on industrial commodities. We provide everything from global ocean freight, break bulk services to the commodity trade and extensive inland logistics operations in North America. Heavy focus has always been on, as I said, industrial commodities, metals, steels, raw materials going into mining, coal, ore, fertilizers, cement, in that range. In addition to the supply chain services that we provide, we've spent a good amount of time over the past several years building part of our business that focuses on collateral management, oversight, risk management, and prevention for our partners in the banking, finance, specifically commodity trade finance space, providing collateral oversight and management services to prevent fraud and other risk elements when it comes to physical commodity trade finance.
Thanks, Anton. John?
Hi, thank you. It's great to be invited on to be part of this. So I'm a financial journalist, have been for about 10 years, and I've been at GTR for the last 5 of those. For anyone who doesn't know GTR, we're a publisher and events company specifically for the trade finance sector. And fraud in commodity trading and trade finance has been one of the most pressing topics and one of the most widely read subjects for us consistently over that time. Thanks again.
And Peter?
Yes. Good day, everyone. I am responsible for business development at Goba Capital. Goba is a Miami-based alternative credit provider, privately backed, very unique business. A single strategy is providing working capital solutions across multiple geographies, industries, and sectors. For the purposes of today's discussion, we're focusing on my role, which is primarily bringing in new business and maintaining relationships in the commodities trade finance space, and what we do differently to those conventional and more institutional type investors. All of us face the same risk, potential loss. The greatest potential loss is going to come from fraud, and next would be simply incompetence among some of the small and medium-sized enterprise and middle market privately held companies where the quality of the information may not be so great. But that's what we're about. We're here in Florida. We service clients from around the world, all the way through commodity supply chains, from production, shippers, traders, marketers, moving goods on vessels, pipelines, rail cars, trucks, to their final destination, and then underwriting those consumers who are paying for those goods as well. They're both bookends of the supply chain.
Certainly a star-studded cast we have here. To begin, let's look at some of the major challenges within commodities markets today and the implications of fraud. Anton, from your perspective, what are the main operational risks involved in sourcing, storing, and transporting high-value commodities and bulk materials?
Yeah. So thanks, Cole. We've of course seen a lot of news, various interesting examples of fraud in many different forms over the past several years and past decades. Actually, several years doesn't even begin to explain the time frame, right, that we've seen this, right, going back to the beginning of trade in time. I'm sure we'll find examples of Phoenician and Greek fraud, no doubt, that are out there. But interestingly, in the past few years, we've seen some pretty significant examples of fraud where a trader, there was the Hin Leong disaster in Singapore, where there was a ship operator that was sitting in the borrower's office and controlled by the borrower, issuing title documentation, bills of lading, right? That should be an immediate red flag, right? If there was a basic amount of vetting on that particular trade. We saw what happened with the Greensill wind-up and mess with Credit Suisse, where they were financing. Credit Suisse was involved in creating funds that financed Greensill's financing that was backed by invoices for potential future sales, right? Which sounds like your average high school student might be able to vet that properly, let alone sophisticated bankers involved in commodity trade. So there has always been, and there always will be, fraud in various forms involved in the physical commodity trade finance space. The challenge to the trade is implementing proper vetting procedures and oversight to prevent sometimes fraud issues that are more complicated and not easy to identify, but sometimes they can be pretty clearly falling under the premise of it could easily be detected with a basic amount of common sense.
Certainly. And John, in your journalism experience, what are some of the types of fraud you encounter most frequently? And what, if any, particular factors are driving these risks?
Yeah, well, I mean, the first thing I'd say is there is an incredibly wide variety of types of fraud or techniques that are used, and across different trade finance products. So Anton mentioned Hin Leong there, and one of the most talked about mechanisms in the last few years has been, it relates to letters of credit. So a commodity trader will sell a cargo, it'll apply for a letter of credit to make sure it receives payment. Then, it turns out that trader has actually gone to several lenders with that same sale, financed it multiple times. And, in some of the cases we've seen, that original sale was completely fake in the first place. But another technique I would highlight, which this is not new, but it's I think maybe flying under the radar a little bit at the moment, is in receivables finance. And essentially, this is where invoices get financed that do not correspond to genuine sales of goods. So, I mean, based on some of the allegations we're seeing at the moment, one way this might work is somebody sets up a commodity trader and they manage to present quite a good balance sheet to a lender. Maybe that's due to a mixture of real trades and fake trades, but they use that to get a receivables finance facility. And then at some point down the line, the lender doesn't get repaid. Maybe they have to see if they can claw anything back through insurance or through the courts, but that's difficult and expensive. There are all kinds of other things we've seen. I mean, we've seen fraudsters impersonating real companies, hackers changing payment details and invoices. I know those aren't so specific to trade finance, but and then because trade is still so, going back to your question about what's driving this, I mean, so much of trade is still paper based, especially on the kind of shipping side. So you still see frequent examples of forged documents, misrepresentation of cargo value. That could also have maybe a money laundering element to it, maybe misrepresenting where the cargo originated from, which maybe is getting into sanctions risks as well, and even entire cargoes that turn out to be something completely different when you open the container. But yeah, I would say anything you can think of has probably been tried.
Peter, how does alternative finance fit into this landscape, and what red flags should we look for when it comes to considering new businesses to lend to?
Yeah, it's a hard act to follow because John and Anton have covered a lot of the territory there. But from our perspective, looking at it from an alternatives perspective, private credit investor, where we take a sort of top-down approach. We're looking at the same prudential risk analysis, credit analysis that any conventional institutional lender that's providing these types of trade credit facilities would conduct. But also, to Anton's point, experience-based and relationship-based tests where I'll reach out to an intelligence service or a data provider like GTR, like John, or someone in Anton's space where he's familiar with what's going on at the ports, dealing with the ships agents, the stevedores. Do those reasonableness checks and those reality checks. Are these companies really moving the goods they say they're moving from those origins to those destinations? We look up and down the supply chain at all the counterparties involved, interrogating all that data, making sure that it's legitimate and bona fide, taking that sort of big picture view. And then, is the information inconsistent? Is there something unusual in the fact pattern with the trade flow? Are the payment terms regular for that type of commodity? That type of supply chain activity, and the obvious flags: high pressure for a quick decision. Typically, it's a group that's trying to avoid scrutiny, lack of transparency, anything unusual about that fact pattern. We are offering a very unique and customized offering here, service at Goba. So we're taking a very holistic view. One case that was covered very well by GTR, Phoenix Commodities, several years ago, I recall at the time seeing that, and that was just quite simply too good to be true. Why is such a very large, on the surface, robust, financially healthy company coming to that alternative market where the pricing is clearly different to a SOFR Plus bank? So there's a lot to it, as John and Anton have said, but we see very appealing risk opportunity balance if you can get it right.
Yep, certainly. It seems like John and Anton's experience is super beneficial for your lending approach and strategy, Peter. John, as you prefaced a little bit earlier on some of the recent examples of fraudulent activities, can you please share a fraud case in specific and what due diligence or best practice could have been considered to avoid these damages?
Yeah, sure. So, I mean, there's one we've written about recently of GTR, and I would just say first, this is still ongoing. These are just allegations. There's been no kind of closure to this yet, but it's about a receivables finance arrangement that went wrong. So, in short, a couple of years ago, some sort of brokers or middlemen acting on behalf of a commodity trader in the Middle East, they approached a lender to get financing for receivables that appeared to be resulting from sales to legitimate buyers, real companies. And the commodity trader, provided various documents. The buyers agreed IPUs. It all seemed safe. The lender sent over the funds. But then the repayment didn't come when it was due. The trader stopped returning calls, stopped answering emails. And so the lender sort of investigated. They sort of came to the conclusion that they had been duped. It was an impersonation scam. So they realized they allege now anyway, that the people they were speaking to had nothing to do with those buyers. They were real companies, but they were being given fake employee names. The domains on the email addresses they were corresponding with didn't match the real companies, or all that kind of thing. And in terms of red flags and due diligence, there are probably I'd say maybe there are 2 points here. So one is, similar to what Peter was saying, check everything. And I was speaking to someone this week about impersonation fraud, and they told me they always, in receivables finance, they always phone the buyer, via the switchboard number. They always check email addresses and employee names against some kind of third-party resource. They have a look at the offices, the listed offices on Google Maps. Just do every step possible to verify what it is you're being told. Maybe the second thing is a bit broader than that. We've sort of talked about these different types of fraud. I think it's maybe worth thinking about why they happen in the first place. So some of them are premeditated. An impersonation scam is premeditated, and that's where that due diligence comes in. But in the case of multiple financing on letters of credit, that kind of thing, it could be that the commodity traders started out perfectly legitimate and faced a bit of pressure, found a way to sort of generate some short-term liquidity, plug those gaps. But the issue you have there is once you've started down that path, it's very hard to get off it again. So that's where you have to look out for some of the things that Peter was talking about, some of those red flags.
Definitely. Some of the hoops that these bad actors jump through is just frankly wild, and ones that you would never expect until it happens to you and once you encounter it. Anton, from your experience, how does collateral management best practices prevent fraud?
Yeah, the thing that jumps out at me too, Cole, is as we're looking at this too, we're often a lot of these fraud cases, some of them are a little bit more sophisticated, right? But I think we'd all agree some of these don't rise exactly to the level of the Russian GRU unit hidden in a Moscow apartment building at a sophisticated level, right? We're talking about some pretty unsophisticated stuff that's going on here. And that's why I continue to hammer the point home that with a basic level of common sense, often a lot of it can be discovered, right? John just gave some good examples, right? Google Maps, calling the switchboard, right? Verifying that these people are real. Again, this is the National Security Agency is not needed to be involved to catch that level of fraud, right? But best practices, right? John alluded to some of these, right? We saw recently the large nickel fraud on the containers coming out of India, right? Trafigura had with 1,000 containers of steel discs instead of nickel. In this case, we're talking about a very low cost to send in a surveyor, an inspector on behalf of the trading company buying the metal to go and watch some of the containers being loaded, to take samples from a spot amount of the containers and verify the quality, verify the seal numbers before the containers are loaded. Again, I'm going to sound like a broken record, right? Sometimes when I say, that a high school student could also figure out some of these best practices, right? There are the sophisticated items that need to be done when verifying and trying to prevent fraud, but often a lot of it is the sniff test. And Peter alluded to that, is having experienced people. Sometimes some of the larger trading companies have an enormous amount of staff that are inexperienced, where it's easy to get things by with them, but it goes back to having experienced people putting the sniff test often to a trade. We talked about also looking at unusual trade patterns, right? There was the instance of recently, or a few years ago, where one of the banks got the wool pulled over their eyes, where they were financing containers that were traveling around the world for 200 days, right, to get to their destination. So who was looking at this documentation, right? Who was the NVOCC that issued the ocean bills of lading? There's often NVOCCs and container freight in particular, right? It doesn't take much to get an NVOCC license in many countries, and then you're issuing original bills of lading. That isn't worth the paper that it's printed on. So it just goes back to the need. Best practices go back often to common sense in a lot of cases, and in some cases it needs a deeper dive by more experienced people.
Certainly. Peter, from Goba's perspective, what is the best practice to financing commodities transactions, and how does the lender protect itself from fraudulent activities?
Yeah, I think a lot of interesting territory covered there. So if you look at the anatomy of some of the transactions, or a typical transaction, so the beginning, the procurement stage, that pre-export, pre-shipment, that's where I think you're particularly exposed, in that you're looking at the validity of those quality and quantity documents, who's inspecting those goods, who's performing those audits, making sure that you're dealing with legitimate bona fide operators, the ports, what's the history of the port like? Is it run efficiently? Does it stand up to scrutiny in terms of its operating history? The vessel operators, that's where Anton would come in. Once delivered, then, John's touched on probably we talk about trade finance. It's a very common phrase. What does it really mean? If you talk to a bank, it means post-shipment finance. Either they're financing either receivables or payables. We do not purchase receivables in the secondary market, meaning, so John or Anton pop up one day and they say, Peter, look, we've got these investment grade, wonderful companies, and we can meet all your investment criteria. Please, wire the funds to this account. We won't do that. We want a relationship with the company. And when there is a receivable financing component involved at Goba, we'll protect ourselves by going to the company and having them formally execute an acknowledgement letter saying that they owe the debt to Goba. Any misdirection of that payment or non-payment would be blatant fraud on their part. They are contractually bound to pay us. That some of the measures that we take. But again, at the end of the day, we're in the trust business and the relationship business. Digitalization, important, AI, machine learning, blockchain. There's some technology providers out there that are helping in the space. The problem is that you don't have the entire universe on any one single platform. So again, it's a labor-intensive approach. People, processes, and systems, checking and verifying. In the space we're in, so we're looking at the three big groups: energy, metals, ag. They're quite clubby markets, so we're probably only 1 degree or 2 degrees away from someone that I or one of our partners know well that could say, look, there's a reason to be careful with this particular counterparty, or guess what, that material originating at that location, I think if you get a geologist or a mining engineer involved, you'll find that just is not possible. So again, it's very much what Anton says. We take a very pragmatic, common sense approach. Is this too good to be true in any way? Then we get very granular in terms of our due diligence at a forensic level.
Yeah, and I'm curious, would you engage Anton and his team for pre-export needs and work, or when would you engage Anton for specific consulting?
Yep. So Anton and I frequent contact and reference checking back and forth, showing one another opportunities. It would be pre-export where, I would say, look, Anton, we're assessing this opportunity. This is the expected timeline. We're at the term sheet level, or we're close to the term sheet level. I like to preview and get in front of it. And then it makes a much more efficient process. If you said, Peter, I know them and I'd steer clear of them, we get that information early on. But formally, yes, when we're either moving the goods or they're in a warehouse and we need some auditing or surveillance done, some advice, that's when we would engage in.
Yeah, we jump in too on that. Peter described it perfectly, right? The time where it's most critical is before it's formal, right? When Peter's looking at the very early stages of a trade, a potential client, region, commodity, we have that casual chat about what we've seen in the market, what ideas of where we would think there could potentially be problems, and planting the seeds right in Peter's head of some of the ideas and some of the things that I think would be important to cross-check and verify in the early stages of that discussion so that Goba can decide if it's even worth it to proceed in that basis. And often that's what's missing and most critical when we're dealing with some of our partners in the banking side. We often are brought in to do an audit, but the trade's already done, right? The problem's already there. So if we're not involved at the early stages of the setup of the structure of the trade finance, it's very hard to be the cleanup crew afterward, right? So I think all of us agree, whether it's trade finance or aviation maintenance, the key is prevention of problems first and not fixing problems after the fact.
Yeah, and I think, going back to a point made by John too, it's ongoing monitoring and surveillance. So we will visit our clients prior to closing. We'll have visits throughout the year. We may send in, if it's far afield, we may send in an independent, trusted third party. So it's constant monitoring and scrutiny at that level.
Yeah, and if we're not reading about the deal from a TDR headline, then we can consider it a win, right?
Yeah.
Yes, we want to reduce the amount of stories that John has to write about
Yeah.
on this topic.
Great, guys. Let's move into the last segment here. And looking to the future, I'd like to talk about where the industry is headed. What shifts do you see coming, and what role will risk management play? Anton, let's go ahead and start with you.
Yeah, so this interesting topic, it's something John and I have been talking about extensively. We're seeing, a big part of my background and Mercury's business has been in the metals mining space. And with the energy transition being such a big part of global economy, at this point, we're seeing a lot of new players coming into that space, right? Energy focused trading companies, for example, moving pretty significantly into the metals mining space as they want to take advantage of and have a foothold in the metals part of the future of energy, right? Copper, cobalt, nickel, right? You can name a dozen other metals in that space, right? So this means there's a lot of people on the move. There's an enormous amount of shifts going on right now. There's been articles written about the hiring frenzy in the metals and mining space, something John and I have been talking about extensively. This also means that there's some significant amount of inexperience coming into play in this space too. So more work, certainly a lot of work to do for these companies that have traditionally been in maybe crude trading, oil, petroleum, commodities trading that are moving into a completely different space, taking on large new staff, right, and have to put in place checks and balance system and oversight systems to monitor and maintain proper control. So that's a challenge. However, that I love seeing it. I love seeing the interest in what's happening in the metals part of the commodities space and how significant a part that's now playing in the day-to-day discussion of the global economy, right? So we're seeing this in not only an investment by governments, by companies that want to have their foothold in the space, but also, of course, the news media, the global discussion on this topic has ramped up significantly over the past few years as part of all things energy driven. So optimistic. We got a lot to sink our teeth into, a lot to keep us busy with, which is great.
Yeah, and the quality control is certainly key in that regard. John, from your standpoint, what do you think will shape the future of risk management and regulatory compliance in commodities?
Yeah, it's a really interesting question. One thing that I think is already having an impact is now. So we're speaking in end of 2024. We're now almost 4 years after that kind of spate of fraud scandals in commodity trading. So a lot of cases have worked their way through the courts now, and so there's maybe a bit more clarity in the industry about where the liability lies if something does go wrong. So there's one. I mean, there's loads of cases you can look at. There's one interesting one which relates to Hin Leong, which we've mentioned a couple of times already. It might have some implications for commodity traders who are involved in back-to-back trades or kind of circular trades, and the banks that are financing that stuff as well. It's incredibly complicated, but I'll try and give a simple overview of what happened. But back in early 2020, Hin Leong was buying fuel from another trader called Winson Oil, LCs issued by Standard Chartered and ICBC. Those trades were part of a sort of circular string of back-to-back trades, so the cargo would start and end with Hin Leong. That's not uncommon in fuel trading and oil trading. It's perfectly legal, but in this case, Hin Leong suddenly collapsed. It became clear pretty quickly there was a potential fraud issue there, and the banks refused to pay Winson under those LCs. Essentially, they argued that the transaction wasn't genuine. And as it turned out, it wasn't genuine. the cargo had already been sold to other buyers with separate financing, forged documents, and so on. But it was Hin Leong that committed the fraud, not Winston. So this sort of developed into a court battle. And only a few months ago now, as we're talking, the banks won that case. So the conclusion the court reached was that Winston was essentially acting fraudulently itself when it presented documents for payment under the LCs. And the reason it was deemed to be acting fraudulently was because it was reckless. It was indifferent to whether the documents being presented were legitimate or not. Now, every case is different. In this one, there were other factors. I won't go into all of that now, but maybe it's a lesson to commodity traders more than banks, because the banks actually won the case. But when you're talking about a bank refusing payment under an LC because of suspected fraud, the bar for that is really high. Occasionally, we have seen comparable cases where the outcome hasn't been the same. And there are difficult questions here, I think, for banks financing oil trade, especially if those structures are circular and if LOIs, letters of indemnity, are being used, those kinds of nuances. So I think one thing that will influence the direction of travel here is what comes out of other court cases that are still working their way through at the moment. And I would suggest the industry keeps a close eye on that.
I got an interesting story. I'm sorry, Cole, if I can interject.
No, go ahead.
Yeah, it kind of ties into what John was just saying, and I think everyone will find it interesting. And I can leave the names out of it because they're still operating. But we recently, in one that was surprising to me, and another element, it kind of ties into the ship operator being controlled by the borrower. Anyway, this situation with large global Asian trading company financing a producer of steel and metals in Asia that is shipping into North America, and the conditions of the finance and the letter of credit that was issued call for the producer that's borrowing effectively from the trading company to produce ocean bills of lading where the freight is prepaid. And now, of course, that means that a good ship owner, a real ship owner, is not going to issue bills of lading marked freight prepaid unless the freight has actually been prepaid. So the producer, right, the steel producer needs to hand over for the letter of credit freight prepaid bills of lading. But if they don't want to actually prepay the ocean freight and still get their financing, they need to bring in a friend that's an NVOCC operated, maybe a one-man little NVOCC, to step in between them and the real ship owners to issue bills of lading that are marked freight prepaid, even though the freight has not been prepaid, and then submit those fraudulent bills of lading to the trading company in order to get their financing. And we saw this firsthand, and it's kind of shocking and amazing. And more amazing was the lack of anyone caring that it was being done across the board. We stepped out of that business, I think, for obvious reasons. It led me to the part of what we would do, working hand in hand with Peter right on a new deal, would be that not only does the producer need to hand over freight prepaid ocean bills of lading in order to execute the letter of credit, but as the lender needs to have the ability beforehand to vet who the ship operator, the carrier, is going to be, so that it's not Fred's freight forwarding, out of the Seychelles, right, issuing a bill of lading. Because if there's nothing in the deal, in the structure of the deal at the beginning, that says that, let's use Goba Capital, right, as the example, that says Goba Capital will be involved and has to approve the carrier and who's going to be issuing the title document, the bill of lading in this case, then Fred's freight forwarding from the Seychelles is perfectly valid to submit a prepaid ocean bill of lading to the bank. And even though the freight has never been prepaid, we witnessed that firsthand. And yeah, it just is another brick in the wall of fortifying the collateral, right? Collateral control and fraud prevention. So anyway, thought that was an interesting case.
Super interesting, especially when you look at it from a sequence of events. Peter, what changes do you foresee for the credit investor as it pertains to commodities? And how do you think the private markets will react adapt, and evolve.
Yeah, Anton's contribution there were sort of the four horsemen of the apocalypse. I like to say volatility, uncertainty, complexity, and ambiguity. And I think that's, the key takeaway from this discussion. It's a very unique, complex space. And, between us all, decades of expertise and deep knowledge foundations here. And we'll still learn a lot and be surprised a lot. I think that there's a lot of positives here for the private credit space and for Goba in particular. The growth opportunities. We're increasingly filling those gaps left by departing banks, traditional lenders, and you're seeing the likes of the Bridgewaters and State Streets, these behemoths, paying attention to it now. That they're all super bullish about their private credit portfolios and the growth trajectory that they offer, and we are too in that space where we're focusing on those small, medium-sized enterprises, mid-sized businesses. I think market expansion, risk-adjusted returns, and flexibility that these solutions offer, it will be ongoing. I think to sum up, we are embracing technology. Technology is your friend when it comes to diligence, monitoring, and blockchain, AI, machine learning. They can enhance transparency and security. We're always strengthening our compliance frameworks, AML, onboarding, KYC, continuing to foster collaborations with the likes of Anton and those in his space, and John and other intelligence services and data providers, continually educating and training our own staff. It's about adaptability and innovation. I'm very positive and optimistic about the future for the space, and look forward to working with all the participants on the panel for years to come. It's a fascinating world.
Yeah, it certainly is. And this session definitely helped us unmask some of the fraud we see in today's trade finance and other lending types of behaviors. I'd like to thank you guys for coming into the session this morning and sharing your insights. It's clear that while the commodities industry faces significant challenges, there are also ample opportunities for those who navigate these risks wisely. And to our listeners, thank you for tuning in to the Success Exchange powered by Goba Capital. If you found today's episode valuable, please subscribe to more discussions on topics across finance, business, and innovation. Thanks so much for your time and have a good rest of the day.